Tax returns are the least useful documents when it comes to qualifying self-employed borrowers for a mortgage. If you're self-employed, what you actually earn and what you report on your taxes are often two very different numbers, and lenders finally understand this. Keep applying for mortgages with your tax returns, and you'll either get denied or massively underapproved, costing you your dream home absolutely. I'm Andrew Russell, owner and founder of RCG Mortgage. Just found out 4-time winner of NAMB Broker of the Year. That's right, Mortgage Broker of the Year. And I specialize in working with self-employed clients, entrepreneurs, business owners, in giving them the right mortgage products and helping them achieve real estate riches. So the biggest thing with self-employed programs and non-QM mortgages and all these cool types of loans we're about to speak about is it has to be out there from an education perspective. There's just not enough education on what they are. Otherwise, the masses would know. Hence, these amazing YouTube videos. So I work with a ton of realtors, probably hundreds at this point, that know, like, and trust me and send me their clients. It turns out one of them wanted to be a client themselves. So as is most realtors, they walked into their local bank and they wanted to buy a certain house and get pre-approved. And they assumed if I go to the big bank where all my money is, I'll get the best deal. So what do? They went there and they showed their tax returns. And on their tax returns, of course, if you're a realtor and you work for an agency, you typically get a 1099. So that 1099 is basically cash. So that top end number, this agent actually made $400,000 on their 1099, this young lady. And in her head, she thought she made over $30,000 a month if you kind of average it out. And what's the big deal? Even if I buy a $1 million property, putting 20% down, which is very typical these days, which is pretty crazy. That's another story. I should be able to qualify 1, 2, 3. Well, it turns out this realtor's accountant was actually pretty good. And what do I say is he took the legal expenses, wrote off a ton of expenses between business use of the home and between meals and entertainment and all the good stuff, travel. Obviously, they're traveling to show open houses. This agent actually worked in the Hamptons, so there was potentially 2 hours, 3 hours of driving each time they had to go. So that $400,000, it actually netted somewhere in like the $60,000 range. So there was $340,000 of expenses. I'm not a CPA. Apparently, it was all viable. But the problem is they went, seemingly it would be so simple, right? $30,000 a month. How could you not get qualified for $1 million house, putting 20% down? They went into the bank. They gave their 2 years tax returns. That's what the bank asked for. Who looked at the Schedule C, sole proprietor realtor filing a Schedule C, and saw the written down income and straight up denied them and said, are you crazy? You can't buy $1 million property. You make $5,000 a month. You qualify for about $2,000, $2,500 mortgage payment. And the $1 million property, the taxes a month were about $2,000. So you just don't qualify for a mortgage just in general. So somehow this came up casually as we were speaking about another client that this young lady was referring to us. And I said, I don't understand. How did you get denied? You're killing it right now. And she's like, yeah, I'm a little embarrassed to ask some of my preferred partners like you to do my pre-approval. So I walked into my to my bank and they said a big fat no, so I'm just going to give it up and rent for another year. I'm like, I don't understand. What am I missing? So turns out she just didn't realize there's all these other cool programs. So the one that was the easiest for her was the 1099 program. Now, what is that? Now, typically a 1099 is considered cash. So if she made $400,000, say in 2024, that's considered actual cash. We don't work off that. We look at the Schedule C for a conventional mortgage. So after expenses, that net profit on the bottom of that tax return on that specific page, that's what we use for the income. Now, with this 1099 program in the non-QM space, we were able to use the actual 1099 less 10% for expenses. So think about that. I don't even know the number. What is that? 400,000, 60,000. It's like an 85% expense factor, writing it down to 60,000. So the new guidelines for these non-QM mortgages, specifically for a 1099 contractor, instead of looking at the tax returns, don't need them, don't ask. We get the last 2 years 1099. So in the case of this young lady, it was like $350 in 23, $400,000 in 2024, and year to date was in line to be a little bit higher, believe it or not. And what they do is they average all the months. So 12 months is for 2023, 12 months for 2024, and year to date, call it 6 months. So that was 12, 24, 30 months. Take all that revenue and divide it by 30. And that number, you take 90% of that or a 10% expense factor. And if you remember, her CPA wrote off about 85%. So she was just going into the wrong program. So how did she not know this? I don't understand. She's working with your boy, Andrew. How do you not know this exists? because big banks don't offer these programs. You have to work typically with a mortgage broker company who's on board with all the lenders that offer these cool new programs. So if you do the math, which we'll go over in a bit, $1 million property, 20% down, $800,000 loan, it's about $5,600 a month. $5,600 a month plus tax and insurance was roughly, even call it $8,000 a month. So she was making about $30,000 a month. It was a little over that. Took 10% off the top, so at $30,000, she had a max payment opportunity, believe it or not, of around $15,000. So obviously a payment of, $8,000? That is lower than she qualified for. So qualify, that's something that she could have got if she wanted, and she was able to qualify all day long. And it turns out, which is super cool, the 1099 program with 20% down, the interest rate was only a quarter higher. So talk about a massive swing. She was going to rent, not live the dream, the American dream, not the proverbial, the dream. And she was able to purchase, get herself a great deal. She's obviously an agent, got herself a great deal. And she was able to, I guess when some people get so caught up in I'm going to get declined, I'm not going to give it another chance, she opened her mind to speaking with other parties, specifically me. And just like that, she was able to purchase this house and had an amazing ending for her. And of course, I hear all you guys saying, Andrew, you always oversimplify this. What am I missing? I don't get it. Why is it so easy? What's the tea around this stuff? It's just these non-QM mortgages, how they calculate income. Remember, I always say in all my videos, guys, he or she who lends the money makes the rules. So the way they look at the income is they don't want to look at tax returns. They realize there's some stuff going on there. They'd rather look at the 1099s, and the way they calculate the income off the 1099s is just very aggressive. So based off of that, that's how she qualified. It is just as simple as that. It's just sometimes you're being put into the wrong mortgage product. Sometimes for two teachers putting 30% down, sure, a conventional mortgage might be easy. But for a real estate agent, a business, a newly starting entrepreneur, an investment property. There's so many mortgages out there. You just have to make sure you're using the right one. So in the case of this young lady, we just put in the right one. And guys, it is that easy as long as you work with a professional that works at a broker company that has access to all these types of loan products. So they put you in the right one and they're not stuck with only the mortgages that their bank offers. And of course, Andrew, you're glazing over the rate, which I didn't. But if someone said you're glazing over the rate, I'm sure it was so much higher. No, it's not so much higher. If you do the math, a quarter higher in rate, you can even buy down the rate, right? So I've done the illustration in other videos where if for a quarter higher in rate, if you buy the rate down an $800,000 loan, that's $8,000. So you could say a 1099 loan in this case, if you're comparing it to the market rates of a conventional mortgage, is $8,000 more in closing costs for the same rate. But to qualify for a conventional loan, she would have had to shown a way higher net. So say instead of $60,000, she had to show the IRS, what was it, $240,000. She may have had to pay $60,000 in tax liability. So would you, one of my YouTube fans, pay $8,000 or $60,000? Which would you rather pay for the same rate? Which you don't even necessarily need because we're in a downswing on the rate. The rate environment's on a downswing, so eventually you're going to refi anyway. But just proves the point. It's a far better option, and it's more financially prudent. And of course, hey, Andrew, this is why there was a crash. This is why all these crazy movies came out, and house prices went to you-know-what, and people lost their homes. Well, that's not the case now. The reason is people are putting at least 20% down, so there's equity. In the crash, people were putting, not only they were putting no money down, they were getting money back at closing to buy a house, which again, conceptually to me, someone who's born in this market specifically makes no sense, but those type of programs don't exist. And credit profiles now are exponentially better. These programs are 680, 700 scores. My typical non-QM purchaser always has around a 680 or 700 or better. It doesn't get worse than that. They look at credit profiles, mortgage rates, pays their debt on time. So credit profile means something. And of course, the last piece is the assets. They want to make sure you have reserves. What's a reserve? Her payment, if you remember, guys, was $8,000 a month. So if you have $100,000 in the bank after we close, which she did, that's considered a year, 12 months worth of reserves. 8,000 times 12 is 96,000. She had that or above, which means a year's worth of payments were in the bank after we closed. So because of that, all the equity, all the money getting put down, a great credit profile, and all the money left in the bank for a rainy day, these loans are super safe. No crashes are coming. All right, guys, in the case of this agent and the exact purchase avatar that we just did, I'm going to show you exactly if you're self-employed, business owner, anything of the sort, why it didn't work with plan A, which is, walk into your bank that you bank with, right? That's always plan A. I'll show you specifically and granularly, I think that's a word, sounds good. Let's count it. Why it didn't work, and then I'll show you, of course, the 1099 program, why it did. If that wouldn't be the case, or maybe a different type of business, a bank statement program, which is 12-month bank statements, we use that for the income to qualify for mortgage, what that looks like. And if that doesn't work, the P&L, profit and loss program, what that looks like. But before we do, make sure, guys, right now, go in the description, click the link, and you're gonna get our free cheat sheet for self-employed income. Our team spent so much time on this, guys, and it's free, there's no catch. We're not gonna stalk you out. We're not gonna show up, knocking on your door, asking for some dinner. Make sure you go to the description, click the link, get the free self-employed cheat sheet. It is awesome. And if any of this is resonating with you, I do this for a living. I work with thousands of non-QM clients. In your case, you might do something different. You might be an entrepreneur, business owner, and this type of thing is a little bit convoluted to you. So make sure, go in the description, click the link, get the free guide. All right, so we're gonna go over our real estate agent. We're gonna call her Sally. Sounds like a name of a real estate agent, right? Right. So just remember, Sally, the avatar, $1 million sale price. Everyone likes the dollar sign. She was putting 20%, or did put, actually, because she closed, 20%. As a down payment, she got herself an $800K mortgage. So where did it go wrong for Sally? So we said option number 1, we did a conventional mortgage. So where did it go wrong? If you remember, Sally crushed it in 2024. She made $400,000 off her 1099 at her real estate agency. So that $400,000 on the conventional loan, if you think of a Schedule C, so let's just write a C here, guys. If you're out there and you file a Schedule C, I'm sure you know what it looks like, right? $400K is on the top end for the revenue. Now over here are the expenses. She had about $340,000 of expenses, showed a net to the IRS of $60,000. Now, why would you want to do that? Because when you're 1099, Sally has to pay taxes to the IRS after the year. Sometimes you do throughout the year, but oftentimes she's paid at the end of the year. She would have had to pay off $400,000. So her expenses, she did, as an example, what would an agent pay on expenses? Maybe your marketing costs, maybe your travel and entertainment costs, maybe some car expenses, like I said, a lot of gas. Whatever it was, there's a lot of stuff going on, but $20,000 if you're spending a lot in marketing. She worked in the Hamptons. Remember, the Hamptons is high-end, guys. So there's probably some mailers being sent out, open houses that are expensive, maybe an event for the local community to really get her name out there. It's expensive stuff. So, and this is all, in the name of business, you could write it all off, so you only pay tax on that $60K. Now, the problem is, Sally, the great news, she had a 760 credit score. Good job, Sally. And she didn't really have much debt, so we could just write no debt. It was nominal. A couple small cards here and there. Maybe she went out to dinner, charged, but nothing crazy. And a car payment was minimal. I think it was something like $600 a month. So because of that, $60,000, if you divide that by 12, for mortgage, we're giving her credit for $5,000 a month, guys, which is no bueno. So from that $5,000, if half of that can go towards debt, including the mortgage, now you're at $2,500, subtract the car and the other stuff, let's call it even $1,800. That's what's left for the mortgage. Now this property, taxes were $24,000 for the year in taxes. Insurance was $6K for the year, I believe, for insurance specifically. I know before I guesstimated. Right now it's all coming back to me. Isn't that a song? It's all coming back to me now. But it's $2,000 a month for taxes, $500 for the insurance. So just for escrow, including your tax and insurance, you're $2,500 a month. She qualifies for $1,800 a month. She never had a shot to buy this house in option number 1, right? So that's the first option. So the second option is obviously, for her specifically, it made sense, the 1099 program. So number 2, which was a 1099 program. So again, 2024, she killed it $400K, but for 24, she made $400K. For 2023, she made about, I think it was like $320. But then year to date, YTD, I believe we did the mortgage around 7/1. So that meant 6 months. So year to date, I think she was at like 300. She was killing it. Outstanding agent. It's all ramping up. All right, so if you add all this together, that's $1,020,000. But that's over 12 months, 6 months. So over 30 months. So this nets out to about 34-ish K a month. So just follow me. If you look at 2023, 2024, and year to date, you add it all together and divide by the amount of months that is, which is about 30, you get about $34,000 a month. So it's not that simple. You take 10% off the top, which is like another $3,400. So just to keep this real simple, she gets credit for about $30,000 a month of income. So if you remember, she got $5,000 income, or she got $30,000. So this is like 6x the approval just working off of this. So at $30,000, she then is eligible for $15,000 in debt. If you subtract the car and the minimal debt, even if you want to call that $14,000 left for the mortgage. So the mortgage, right? You had $1 million, 20% down, $800,000. So if you did a rate of 7%, rates are coming down. We're just going to do a little estimate here. Rate of 7% with a 7.5% APR. It's going to be something like $5,600 a month for the mortgage, plus the $2,500 for taxes and insurance. See, I was close before. So that's what, $8,100 a month. So her all-in payment is $8,100 a month. We use this for qualification. She qualified for $14,000, so she qualified. Now, the reason she qualified for this is, number one, we just went over the income, $30,000 a month she got credit for, more than enough for an $8,100 mortgage. Number two, 760 credit score. That's obviously exceptional. It'll work all day long. No real debt. And number three, which we didn't put, she had about $100,000 in cash post-close, which is that $8,100, that's over 12 months of mortgage payments in the bank for a rainy day. And that's what they look at from a reserve. Remember, this is called reserves, right? So from a reserve perspective, this is why she qualified, and it was simple. Now, this 1099 program, say she wasn't a real estate agent, say she didn't get a 1099, say she did in fact make all this money in revenue, but she didn't get a 1099. Option number 3 here would be bank statements. So if we go over here, let's see if we can keep adding to this. So this is number 1. This is number 2. 1 was a big fat no, if you remember, guys. So the third, if we did a bank statement program, let's say, if you're a self-employed business owner, entrepreneur, all the above, and you're making $600,000 for the year in revenue, this young lady made $400,000. Let's say now all of a sudden you're a business owner making $600,000 for a year. Same issue. Option number 1, you walk into your local bank, that's $600,000. Maybe you give yourself a small little salary, write the rest off so you don't have to pay tax on it. You're just not going to qualify for this $8,100 mortgage. So in a bank statement program, $600,000 for the year is $50,000 a month in revenue. We'll look at the last 12 months. So in a bank statement program, again, this is based off of 12 months of your bank statements. So we're going to look at the last 12 months of your bank statements. We're going to add together all the deposits, make sure they're consistent. Let's say in this option that this client is consistent, that every single month it's about $50,000 a month, 60, 40, 60, 30, 70. Like it's kind of all within range. And over the year, it's $600,000. So $50,000 a month is the average of their deposits. So from an income perspective, we'll give them credit for half of that, $25,000 a month. Assuming that they're 100% owner of the business, let's assume that they are. So the same thing. It's a little bit lower than before, but it's about $12,500 is the max amount of debt. Same thing if they had cars and little things. So let's say it goes down to $11,500, $1,000 of debt. Let's assume that $8,100 is still less than $11,500, so you'd qualify. So again, the bank statement program, similar to the 1099 program, but we need 12 months of your bank statements. Not the biggest deal. Go into your online banking, save 12 PDFs. Send them to your mortgage guy, which should be me, and we will review them, make sure that the monthly revenue and cash flow is equal to that number. Now, we don't care about how much is spent. We don't want to see negatives, overdrawing, NSFs. That's a bad thing. No bueno there. But if you have $50,000 coming in every month and you end the month with either zero or a little bit of a gain, that's all they're looking for. I know it sounds crazy, but that's how they calculate income. So in the case here, $50,000 a month is what the revenue is. Half of that you get credit for income, assuming 100% owner of this business, $25,000. From that, it's a lot of halves, right? Half of that for debt, $12,500. Let's give this person room for $1,000 a month in monthly debt payments, which our real estate agent had a little bit less. So that $11,500. The mortgage payment's $8,100. Max qualification is $11,500, so you qualify. So Yes. Hey, Andrew, why is it so simple? It is simple. These are amazing programs that they made very user-friendly and very simple. It's just you have to work with companies that offer them. The big banks, at least right now in the filming of this video, they don't offer it, and it's not looking good that they're gonna. Now, the fourth option, like Andrew, that's so simple. Why would you ever need a fourth option? The P&L program. Now, when you look at bank statements, guys, they're gonna wanna see consistency and non-volatility. So in other words, if it's 50,000 a month, they don't wanna see 100,000, then zero, then zero, then zero, then 200,000, then zero, then zero, then zero, then 150,000, because they don't know, there's too much volatility in the revenue. It's inconsistent. They're going to deem it not usable. You might actually get declined for a bank statement program. So what makes a profit and loss program good is, say that same thing. Say we had $600,000 in revenue. It's based on the last 12 months, a profit and loss program. So what is a profit and loss? Profit and loss, in simplistic terms, is if you think of an Excel. On the top of the Excel, you have a section for your revenue. The last 12 months, so say you did, where are we? September of 2024 to the end of August in 2025. The last 12 months, the business brought in $600,000 in revenue. Now under that, think of an Excel, is expenses. Say over the last 12 months, the business had $250,000 worth of expenses. Or actually, we can make this simple, $350,000 worth of expenses. And what does that mean? Whatever your expenses were. Only, not of the calendar year, it's literally the last 12 months. So that nets out to the profit, which is $250, right? It's literally A minus B equals C, right? That kind of makes sense. So again, a profit and loss program is when a self-employed client has, through their CPA, they do a rough, this is what I made in revenue of the last 12 months. These were the expenses. This was the profit. So we go off of that profit number. Now, this isn't audited. This is just like reaching out to your CPA and getting the numbers. So sometimes businesses, you can time the expenses, right? Sometimes expenses are the most at certain periods. You double dip on certain expenses. So in the profit and loss program, profit and loss programs typically have a little bit higher of a rate of a bank statement program. So you're not really showing it per se. You're not showing your revenue coming in. But why would you ever want to use this? Like I said, remember the volatility. So say if you're doing 12 months, all right, man, my kids are going to make fun of me for my handwriting, I'll tell you that. So over these months, on the bank statement program, it was around $50,000 a month, no inconsistencies, cool. So on the profit and loss program, say you had January, you start the year fast with 100,000, then you have zero, then you have zero, then you have zero. That's really bad, right? It's not bad necessarily for you, for your company, for your revenue, but for an underwriter, it seems super inconsistent. How they give you credit for any type of income when it's all over the place. And then say in May, you made 200,000. And the same thing, zero, zero, zero. Right, we're gonna get to 600. Say in September, you're back to 200, right? So now you're up to 5, 0, 0, maybe 100 here. What type of business would this be? There's plenty of businesses that are maybe you flip houses and you do only a handful, or maybe you're a new construction builder and, right, you have 1, 2, 3, 4. Say you're a new construction, like here's a realtor, Sally. Say Billy is a new construction realtor, right? So he's a new construction developer, sells 4 houses, builder, the whole thing. The 4 sales, that's when he makes his money, and he makes a good chunk, but outside of that, there is no money's coming in. So he would be best fit for this profit and loss program because we'll add all that in terms of revenue. Here's your expenses, there's your profit, and we go off of that at face value, assuming he's 100% on the business, which is, let's say Billy is. So that's $20,000 a month. So the same thing applies, guys. You're starting to follow, right? $20,000, that's the monthly income. He gets credit for $10,000 a month in debt. $10,000 a month in debt. Reduce that, say $1,000, on average. Now you're down to $9,000. This mortgage is $8,100. Billy qualifies. All right. So this has given you the best illustration. Of course, before I reiterate this stuff one more time, hop in the description, click the link, make sure you get the free self-employed guide. It's going to go over all this stuff. I did it really quick with my chicken scratch, guys. But to me, I love this stuff, and I can do it all day long. But for you, you want to keep it simple, make sure you get the guide. It's free. And our team spent a lot of time on it, and it's exceptional. Make sure you hop in the description, click the link, and grab the guide. So let's just reiterate. So we had Sally. Sally wanted to buy $1 million property, wanted to put 20% down, $800,000 loan. She walked into her big bank. They said no because her $400,000 1099 crushed it in the real estate game, netted down to $60,000 for the year, $5,000 a month. Didn't even qualify for the taxes, let alone taxes and insurance. Didn't work. Spoke to her boy, one of her preferred lenders, her preferred broker, LO, Andrew Russell, and I was like, hey, I don't understand why you didn't qualify. You killed it on the 1099 side. She's like, well, they looked at my tax returns. I said, well, girly pop. Didn't really say that, by the way. Let's look at your last 2 years 1099s. We did. We got her year to date. And with the new non-QM 1099 program, she got credit for about $30,000 of income, which qualified for this $8,100 mortgage all day long. Now, if she wasn't a real estate agent, if she was a business owner or something with some revenue coming in over the year, let's say $600,000 for revenue, which is a good number. If she owned the business at 100%, $50,000 a month in revenue, half of that for income is what you get credit for, $25,000. Again, half of that for all your debt, $12,500. We're assuming just loosely about $1,000 a month in rough debt. $11,500. $11,500 is what's left for the mortgage, qualification-wise, on a 12-month bank statement program review. More than $8,100 qualifies. Now, if Sally, turns out we're going to do an example of a gentleman named Billy. Billy builds and sells houses, builds 4 houses a year, maybe flips them and makes a ton of money, something similar. And in this instance, in the last 12 months, flipped 4 houses, made 100, 200, 200, and 100, which is great money. But it's inconsistent, and he never knows when they're going to close. The P&L program is best. Why? We don't look at the bank statements. The underwriter's not going to see the down months. The underwriter's just going to see the 12 months of the $600,000, the expenses, and then the $20,000 net. Same thing for Billy, $20,000 monthly income. Half of that for debt, $10,000. Reduce that $1,000 to $9,000. After you assume $1,000 a month in debt, $9,000 is greater than the $8,100. So Billy qualifies. And as you can see, these programs didn't exist years ago. So if you're self-employed, typically you're going into a big bank, you're getting declined, you'd have to show so much more income, not write off your expenses, pay tens of thousands, if not 100,000 in IRS tax debt just to qualify. But now, all you have to do is work with a broker company with the best LO who knows all this stuff, be put in the right mortgage, and it's cake. You can qualify all day long. Now, if you're self-employed, guys, the next question is, which of these mortgages is best for you? So make sure you click the link over here, watch the next video, self-employed, which one of these mortgage types is best for me, right? We're gonna go over all the different mortgage types again, go over your financial picture through and through, and we will go over exactly which of these mortgage types makes sense for you. Make sure you click the link, watch the next video. It's awesome.